ask you something. If you suddenly started earning 100,000 Rand or 300,000 Rand a month, would it be smarter to take that income as a salary or earn it through a company structure? Many people assume that this answer is simple. They believe that companies pay less tax. But that is not entirely true. And that is where understanding the structure becomes very important. Hi everybody, I'm Humairaa from HM Accounting. Let's break this down properly. First, if you earn income as a salary, it is taxed under the South African personal income tax system, which is progressive. So this means the more you earn, the higher your tax rate becomes. It starts at 18% and it goes up to 45% for the highest income bracket. Now, your employer deducts PAYE every month and the compliance is relatively simple. But when that income flows through a company, the tax system changes. Companies currently pay 27% corporate income tax on their profits. And at first glance, this seems much lower than the 45% personal tax rate. But here's the part that people miss. A company is a separate legal entity, which means the profits inside the company don't automatically belong to you personally. If you want to take money out of the company, you usually do so in two ways. The first option is a salary. But once the company pays you a salary, then that income is taxed again under the same personal tax brackets. So the tax outcome may look very similar to earning that income personally. And the second option is dividends. Dividends are distributions of a company's profits to its shareholders. And in South Africa, dividends are subject to 20% dividends withholding tax. But do remember that the company already paid 27% corporate taxes before that distribution happens. So once you combine those taxes, the effective rate can end up around the low 40% range, which means opening a company does not automatically reduce your tax bill. So why do entrepreneurs use companies? Well, it's more about strategic flexibility. A company allows you to retain profits inside the business, reinvest capital into growth, and structure how and when income is distributed, as well as create separation between personal and business risk. There are also VAT considerations. Currently, businesses must register for VAT once their taxable turnover exceeds 2.3 million over a 12-month period, although voluntary registration can begin from 120,000 in turnover. Now, once registered, businesses must charge VAT, submit VAT returns, and maintain proper records. So the decision to open a company should never purely be based on the idea of paying less tax. The real question is what structure supports your long-term financial strategy? Because good tax planning is not just about rates, it's about building the right financial architecture for growth.